Good afternoon and welcome to the AMP Q3 webinar. My name is Travis Hall, National Manager for Broker Distribution. Thrilled to have all of the brokers joining us today for an update about AMP Bank. Just before I move on, I just thought I'd also acknowledge our AMP Bank Broker LinkedIn page. You can see that on the screen there. So if you've got, if you'd like to follow us, if you'd like to give us likes or feedback about our products, services, and platform, feel free to like that page, and then you can be able to communicate with us moving forward. Today we've got a fantastic lineup for you, and what we'll do is start with an acknowledgement of country, go through the agenda, and then kick on with the presentation for you. So first of all, thank you for attending, taking time out of your business and coming along to this webinar. We would greatly appreciate it. Acknowledgement of country. AMP acknowledges all First Nations people across Australia. We recognise the traditional custodians of the land and value the connection to country, waterways and sky. We pay our respects to the elders for their resilience, courage and wisdom, for ensuring that there's the survival of this country's rich culture and heritage. What have we got in store for you today? We've got a fantastic lineup for you. Today we've actually got Melissa Christie, who's the Head of Lending Origination, presenting to you and giving you information about our brand new digital lending platform and giving you the full rundown as to what's happened since we launched on the 30th of July. We've also got Dr. Shane Oliver, who's our Head of Macro Strategy and Chief Economist for AMP Bank. And Shane's here to talk about all of the things that are happening in the Australian economy and how that's going to impact your customers and also your business as a mortgage broker. I'm going to touch on the strategy and the reasons with why we do what we do with products, pricing, and our strategic position to market, and how we're looking to support you and your customers moving forward and into the future. We've then got some really exciting news to share with you. Louise Chisholm, our Head of Lending and Everyday Banking and Product, will be here, and I'll be talking to Louise in regards to the products that we've got coming and available to you soon, and it's really exciting with what we're going to talk to you about later this afternoon. Then we're going to move into a Q&A, and that'll be hosted by myself, Melissa and Louise, and we'll be able to go through and answer any of the questions that you have and that are pressing. So let's kick it off. Let's start the presentation for you today. I'm going to welcome Melissa Christie stage and get her to talk about the broker platform update and top tips. So, Melissa.
Thank you, Trav. Hi, everyone. So as Trav said, I wanted to give you an update on where we're at with the broker platform since we went live, and some top tips on how best to get the most out of the platform. So since our last webinar that we had, which was obviously our launch webinar, we have rolled out to to 15,000 brokers we put on the platform by the end of August. And gradually through September to mid-September, we rolled brokers off our old platform. So exclusively for the last 5 weeks, we have been on the new AMP Bank broker platform. So how's that going? Look, we've had an overwhelming response, a great response from brokers using the platform, so much so that September was actually the second largest application month for AMP Bank in history. So thank you so much for using the platform and supporting us as we go through this change. Now, we do realise that you know, with such high volumes that we have actually blown out our SLAs, which is unfortunate. It was not something we expected to have such high volumes during this transition. So we have blown out. We are currently have a few apps still on day 7, but we have steps in place to improve that, and we will be in a much better place by this time next week. So I just want to acknowledge that we know it's not ideal, but we are working through it, and we should be in a better place next week. I also want to acknowledge that I know that the platform's new and it is different. It's also acknowledged that there has been some tech issues. With any major tech transformation, there will always be some issues that are fleshed out in production. And this has been such a massive change for us, changing lodgement, assessment and our settlement provider, that unfortunately some of those issues are inevitable, but we have been working through those. And the good thing about getting so much volume so early is that a lot of those issues have now been fleshed out, and the process is now a lot smoother. So thank you for your patience. I also want to acknowledge that the platform as you know, is different. It's not the standard Loan App version 2. It is a customised version, and we know that it does take some time to get used to. So in our launch webinar, we did have 2 brokers on stage that did say it can take, 3 or 4 applications of using the platform to get used to it and to understand where everything goes and to get familiar with it. We acknowledge that. And so we are here to help if you need that help. And we know some brokers, can whiz through it, and some brokers, it takes time. But what we just want to say is we're here to support you. We have loads of training available. If you go onto our distributor centre, the broker training hub has specific videos on things like how to upload supporting docs, how to reply to an info request, how do I use income verification tools. All of that's there for you. There is also step-by-step guides which show you screen by screen what to do. So please use those tools available, but also please reach out if you are having issues, and we can always help you. So what's next? So there is still a lot to do on the platform, and we are working through lots of different things. We are specifically focused on improving how we deal with linked applications because we do get a high volume of linked applications come through. We are improving what we're offering in the top-up space. So that will be continuous improvement as we work through. There is some stuff dropping this year, and we will work through that into the new year. We are also looking at improving and tightening some of our decisioning rules to make the deals go through quicker, particularly with credit. So obviously getting so much volume through, we can see where things can be improved. So we are looking at improving those things. The other thing that you may have noticed is that 90-second docs, which is one of our key features of our platform, has not been turned on yet. The reason it hasn't been turned on yet is because for me, it's most important to get docs out accurately and correct first time. And now that we've seen the volume go through and the different types of applications go through, and we have all the aggregators on board, we are more confident in the data because data is key to 90-second docs. So we will be turning 90-second docs on in November. So that's just a quick update on where we are. I'll now take you just through some tips to help you get the most of the platform. So the first one here is to respond to each information request individually. The reason for this is because once you've completed all the information requests and you've responded, say you have 3, that actually wakes the deal up. And that means that we know that that application is ready to be picked up again for review. If you only respond to 1, we will not know that you're finished because there are 2 still outstanding. So please respond to each one. The next tip is about digital income. Digital income, if it passes on serviceability, please submit it on the digital income. The reason we ask you to do that is because the credit team, therefore, will not get a rule to check income if it's passed already. And that is a key to getting a faster approval. So, we have had brokers that have submitted on declared income because there's $1 difference between digital and declared. It does not make sense. It's still services, and we are going to use the digital income. It's just slowing the deal down when it comes in because credit will need to look at the rule because you've submitted on declared. So please submit on digital where it passes serviceability. A key thing here is also don't put extra income in the other income field to make serviceability work. Serviceability is exactly the same as our old serviceability Excel spreadsheet. It's exactly the same. The key thing is understanding where the data goes so that the serviceability matches. For instance, if there is a refinance deal and a loan is being cleared at settlement, if you don't tick cleared at settlement, it will appear in serviceability. If you tick cleared at settlement, it will come out. So it's understanding those little things that will make sure that serviceability works each time. VOI, we know there's been some teething issues with VOI. If it hasn't worked for your customer for any reason, or we have skipped it because there's a bug, then please provide certified copies of ID, and that means the application can keep moving and we won't need to come back to you or your customer. Ensure the name of your applicants and their personal details are correct before submission. As I said, data accuracy is key, particularly as what you put in goes through to loan documents and approval letters. So make sure that's correct, because if you put in Ben, but the legal name of the applicant is Benjamin, then the application does need to be changed, because it does need to be the customer's correct name, because that has implications for titles and that sort of thing. So please ensure that the applicants' names are correct at submission. And the last tip is really to understand, this gives you a bit of an understanding of how LoanApp works, which might be different to the other platform, is that you need to get your scenario input into the application correctly first. That means all your loans and all your properties in before you can select a product. The reason for that is because LoanApp will only show you products that are relevant to your scenario. It won't show you all the products on offer. So if your LVR, because you forgot to put a property in, is over 100%, we won't show you any products, because we do not have any products that meet over 100% LVR. So the key thing is get your loans and your properties in, and therefore your products will automatically show you what's eligible based on what you've put in. So that's all I had to share with you today. I'm now going to hand over to Shane Oliver, who is our Chief Economist.
Okay, thank you, Melissa, and thank you everyone for joining in today. I've got about 20 minutes, so I'm going to whiz bang through some of these charts and hopefully you can see them. Obviously, the first one is a title slide, but I'll move on to the next one pretty quick. And basically, well, again, the title slide, I'm going to look at the outlook for the economy and so on. But this one I like because it just highlights all the things that have been going on over the last few years. As an economist, I and my colleagues are well attuned to this sort of stuff. Lots of noise out there, lots of stuff around interest rates, inflation, obviously those natural disasters of a few years ago, and some of them are potentially still around. We've got geopolitical tensions have flared up compared to the situation last decade. And of course, we've got almost daily announcements from Donald Trump and trying to work out what they mean, if anything, for us as investors, as property specialists, and in the property industry generally, is a very difficult one. So we might move on to the next slide. To be honest with you, a lot of those things don't have a lot of impact, but the noise can be quite noisy. So I think the key in all of this is to try and turn down the noise. Share markets, despite all that stuff, despite all those worries, high inflation, interest rates, and so on, share markets have actually done pretty well. The last big dip was back in 2022, and we know what happened then. Inflation took off, interest rates rose dramatically in response to that, and we got a dip in shares, much bigger in the US than in Australia. Australia looks a bit like the tortoise moving along there. I should point out that chart relates to price levels, doesn't include dividends. If you add in dividends, then Australian shares look a lot healthier because a lot of Australian companies pay their returns via dividends. So overall, it's turned out okay. You've got share markets around record highs. Not quite there. I think in the US last night we almost got to a record high, and we're pretty close to one in Australia. If we move on, obviously, this is how I see things. I think Trump's tariffs have dampened things a little bit. They do create a lot of uncertainty, but global growth still probably okay, around the 3% level. I know a lot of people say that's pretty depressing, but the reality is that global growth last decade, before the pandemic, was averaging somewhere around 3.3%. Sometimes a little bit more, sometimes a little bit less. So 3% is hardly a disaster. Australian growth, bear in mind, last year we were hovering along around 1%. Some people call it a per capita recession, which it was. We had a per capita recession for almost 3 years. So in other words, GDP per person was going backwards, but the population was still growing, so overall GDP was still rising. This year we'll probably see GDP growth pick up to around or just below 2%. And we've already seen some signs of that in the March quarter, or sorry, the June quarter. And I think the September quarter might show growth along those levels as well. Now, inflation, lately it's gone up a little bit, but bear in mind in Australia it had been pushing down towards 2%. So yes, we're going to see a bit of a bounce back in the current quarter, current month. But I think if you focus on the underlying measures of inflation, the trend there is still down. That's what the Reserve Bank will focus on. Ultimately, that means more interest rate cuts. Central banks around the world have been cutting. The Fed has started cutting again in the US despite the threat from tariffs. and I think the Reserve Bank will cut rates again. They've cut rates 3 times this year, and we expect another cut probably in November. Close call, that one. If not, then in December or February, and one more cut after that. So we do expect 2 more cuts from here. Share markets, I think, sooner or later, you're going to get a bit of a correction. People send me charts called the 18-year cycle and all these sorts of things. I all think it's a bit dodgy when you try and draw zigzags on a chart and say that's precisely what's going to happen. It's never that precise. History rhymes, but it does not repeat precisely. So fitting those things, I think, is extremely difficult. But nevertheless, we have had 3 years of good returns out of shares, and it is quite normal to get a pullback at some point, particularly with price to earnings multiples a little bit stretched. Now, for property markets, I think we're just starting an upswing. It started earlier this year. Obviously, if you're in Brisbane, Perth and Adelaide, you'd say, well, when was the downswing? But I'm talking about national average data here. There was certainly a downswing in the other cities, particularly Melbourne and also Hobart. So on average, we're just starting an upswing. But obviously, again, Perth, Brisbane and Adelaide are leading the charge on that front. This year, we expect returns of around 7% in terms of average prices in Australia, a lot more in the boom cities, a bit less in places like Melbourne and Hobart, and 8 to 10% growth next year. So if we move on a little bit, you often get the impression that we go to the next chart, that Donald Trump's come back and he's still in business. He's launched a cologne. He's launched a phone business. He's now got Trump Time. If you go to Newsmax or Fox, you can see his ads there on a regular basis. But also the tariffs have crept in as a big thing, and that's still ongoing, causing some uncertainty. I often get the impression, if we move on to the next slide, that this is the way Donald Trump, I think that next slide is coming. You might get the impression this is the way Donald Trump sets his policies each day. He spins that roulette wheel to see what we'll do next, whether it's a tax on China or whoever. And that obviously creates a lot of confusion. And sometimes, if you take the last week or so, we've had good news in terms of what he's doing with China, then bad news, good news, and so on. And that keeps markets on their toes to some degree. There's a bit of confusion around that. To be honest with you, if you go to the next slide, I think just as Donald Trump was under pressure back in April to cut deals with countries, which he did. So that saw the threatened tariffs come right down. So at one point, we started this year off, the average tariff going into the US was 2 to 3%. Then it shot as high as that high point there, post-Liberation Day, about 35%, massive tariffs on China. Then he had the pause, then he cut some deals, and average tariffs presently are running around 20%. If he does what he's threatened with China, then we'll go back up to where we were around Liberation Day. And to be honest with you, I think that will cause immense pain in the US because those tariffs are not politically popular when you look at surveys, and he was elected to get inflation and the cost of living down, and the tariffs don't do that. So yeah, he's under a bit of pressure in the US, particularly given the approaching midterm elections. He wants the Republican Party to do well and then retain control of the House and the Senate. So amongst other things, he doesn't have to face Senate inquiries as to his actions. But of course, that means that he has to stay politically popular, and doing too much on tariffs risks threatening that. Particularly if you're someone who regularly goes to Walmart and a lot of the stuff comes from China, you put those tariffs back up to 145% on China, guess what you're going to pay in Walmart? A lot more. So I think ultimately the tariffs will settle back down again, but obviously there's noise around that. Now, if you look at the global economy, if we go on to the next slide, it's not too bad. Despite all this noise, when you look at business surveys around the world, services and manufacturing on the left-hand side, an aggregated number for what they call a global composite PMI. That's a business survey, whether things are good or bad. You can see what happens when they're bad in 2008, 2009 and 2020. Right now, we're sort of in the middle of the range, not too bad. Yeah, maybe at the slow end a little bit, but not too bad in the great scheme of things. And that sort of explains why share markets have been able to keep going. You've got this prospect of lower interest rates. Global growth is continuing to go. Someone asked me one of the questions, there was a lot of questions, well, if gold is going up, how can the share market be going up? I think A, there's somewhat different investors between the two markets, but B, some investors are saying, yeah, we don't mind being in shares, but there's a few risks out there, particularly regarding geopolitics and, of course, the tariffs and so on, a lot of public debt around. So I'm going to take a hedge out. I'll have a little bit in gold. And of course, that's occurring and pushing the gold price up, which again is a separate issue on itself. Is it getting a bit bubbly? Well, maybe. I'll come back to that one in a little moment. But global business conditions look okay. Key is, I think, the next slide. Inflation is still trending down. UK is not so good. Others look okay. US has had a bit of a bounce with tariffs impacting there. But generally speaking, the trend is still down. And if you look at Australia, which is the next slide, and interest rates, those lower inflation rates mean lower interest rates. And you can see in this chart here that most central banks, in fact, all central banks, major central banks, have been cutting rates over the last 12 months. Fits and starts. Some countries more than others. We're a bit of a laggard because we didn't raise rates as much. The Reserve Bank is currently a little bit cautious because there has been a little bounce back in the monthly CPI. And obviously there's a lot riding on the September quarter inflation numbers that come out at the end of this month in less than 2 weeks' time. But I think ultimately those numbers will be benign enough. You've got to focus on the trim mean, the underlying rate of inflation. If it comes around 2.6 or 2.7%, which is in line roughly, I think, with the midpoint of the Reserve Bank's target range, then, given the slight rise we've seen in unemployment in Australia, it will be enough for the Reserve Bank to cut in November. But I'd admit, it's a close call. They could wait till December or wait till early next year. But either way, I think we're getting 2 more cuts in Australia as inflation ultimately becomes a bit more benign, consistent with the trend we've been seeing over the last couple of years. Now, lower interest rates are important because they put more money into the hands of Australian households. If we go on to the next slide, you can see here on our calculation on the right-hand side. So on the one hand, there is pain out there. Average prices over the last 5 years are up 20%. Average wages are only up 15%, 5% differential. The good news is that the rate of wages growth has picked up relative to the rate of price growth, and such that real wages are now rising. So when you look at a household with a mortgage, an average mortgage, you're getting a boost from real wages. That's the top part of that bar chart there. You're getting a boost from the lower interest rates because lower interest rates take a chunk off your mortgage payments or your required mortgage payments. And you've also got a boost from the tax cuts that happened back in July last year. So that stimulus on our calculation is worth about $137 for an average household with a mortgage. So that's going to provide a bit of boost to Australia. And as I mentioned, we have seen a bit of a pickup in Australian economic growth. So if we move on to the next slide, this relates to 5 reasons for optimism. I like to be optimistic as far as possible. Partly hinges from my observation of share markets over the last 120 years in Australia. 8 years out of 10, the Aussie share market goes up. 8 years out of 10, the economy is okay. Sometimes it have soft patches. The last serious recession, ignoring the pandemic, was back in 1990, a long time ago. So if you're constantly betting there's going to be a recession, a depression, a major bear market, you'll be wrong a lot of the time, and you'll miss out on those years when markets go up. Likewise for the property market. 5 reasons for optimism. Inflation has rolled over without recession. Interest rates are likely to fall further. If we do have a recession, and there is some risk of that in the US, I think it'll be a relatively mild one because we don't have the sort of excesses you often have prior to major recessions. Trump, I think, wants shares to go up. He regards that as a key KPI, a key performance indicator, and he wants the GOP to retain control of Congress. And of course, if shares are going down, it means the economy is in trouble, which will make it a lot harder for the Republicans to retain control of Congress. And finally, you've got AI. It can cause problems, AI. You've got to be careful when you ask it to write a report like Deloitte found recently. You've got to check it. Just like they should check any report they write. So I'm a bit surprised about what happened there. But overall, it will provide a big boost to productivity. If we move on to the next slide, is there a bubble in the US share market? Yeah, maybe. I know when you look at the Magnificent Seven stocks, the Apples, Metas, Nvidias, and so on, they've shot the lights out, but then so did the dot-coms back in 1999, 2000. And this time around, those profits those companies are making are real, unlike the dot-com profits, which were a bit make-believe at the time. Likewise, when you look at the broader market, NASDAQ, the S&P, it hasn't gone up anywhere near as much or dramatically as was the case in 99, 2000. So it could be a bubble, could be forming, but I don't necessarily think we're at the top yet. I think that's a bit shade of grey. The gold price, it's had a huge run. I do get worried when I see those people queued up at Martin Place outside ABC Bullion. Looks like a bunch of FOMO going on out there, fear of missing out. Ordinary Australians are getting off the train and picking up some gold from ABC Bullion. That worries me a little bit. But if you put it in context on the first chart on the left-hand side, you can see the rise in the gold price threefold over the last decade or whatever it is. Bit of a non-event compared to the other events that you might have called bubbles over the last four or five decades. So it could be, again, becoming a bubble, but I think it's too early to say that it's at the top, even though it might have a bit of a pullback. Let's move on to house prices. And housing has had a big run. I think in the next slide, you can see we're quite clearly starting to hook back up again. I'll move on from that one. Much stronger gains in some places, particularly Perth, shooting the lights out again, although Perth had a long, weak period after the second mining boom ended last decade. Adelaide doing very well, and Brisbane. Melbourne and Sydney are a bit of laggards, particularly Melbourne, and also Hobart's a bit of a laggard as well, along with Canberra, although they're all showing signs of picking up a little bit. Now, if we move on to the next, one of the things that strikes me about that slide there is just how expensive Adelaide and Brisbane, and to some degree Perth, have become relative to Melbourne. So there is value starting to appear in Melbourne, but some might say that value was there for a reason. Now, there's going to be a big constraint here, and a lot of people ask me about affordability. That will be a constraint. We've seen house price to income ratios go through the roof on the left-hand side there. Obviously, when you got very, very low interest rates, down around 2 or 3% mortgage rates, you could pay a lot for a house. And that's what we saw on the right-hand side there going into 2021, 2022. And it's now going to take a while before we get back to that. In the meantime, the red line on the right-hand side has gone off to the stratosphere again. So affordability is deteriorating again, and that will be a constraint. But whatever way you cut it, and there's all sorts of issues. That there's an unfair situation. I think my generation has not done the best for younger people. But then by the same token, it's not just my generation. I think it's the generation before, and each new generation gets into the housing market that don't want it to go down. The key to all of this is boosting supply, and that's the big problem in Australia. If we move on to the next slide there, I know someone referred to a stat. So this chart shows a combination of things. Obviously, on the right-hand side, we've got the supply of homes in Australia measured by dwelling completions compared to population growth. And what happened 20 years ago was there was a big divergence between those two. Population growth surged. Dwelling completions didn't keep up. We then saw a bit of a unit building boom around 2015, 16, 17. That was good news. Things were okay going to the pandemic. Then they came out again and population growth surged and construction slowed right down. So it's a chronic undersupply of housing in Australia. We simply haven't been building enough homes for the demographic-based demand in Australia. And that, of course, is a key driver of higher house prices. Hopefully one day we'll get it back under control. We have a housing accord agreement out there to build 1.2 million homes or 240,000 homes a year. But at present, we're still way behind that target. Last year, we only built about 180,000 homes. So you've got that shortage of housing. We've got lower interest rates. If you look on the left-hand side chart, usually when interest rates start falling, it kicks off an upswing in property prices. And of course, that's what we've seen more recently. And finally, the other factor, of course, is the low deposit scheme, which I think is a big boost. You can make an argument that maybe interest rates aren't going to come down a lot more. They're certainly not going to go back to the 2 to 3% level that you saw a few years ago. But we've got that huge boost to first-home buyers from the expanded low deposit scheme, which basically means that, yes, there's still some price caps there, but I don't think they're going to affect most first-home buyers, but the income caps have been removed. That means that you don't, if you borrow less than, say, have a deposit less than 20%, then you won't have to pay lenders mortgage insurance. And secondly, that you can get in a lot earlier. It won't take you 12 years or whatever it is to save for the average deposit in Australia. You can get in after 3 years. And I reckon a lot of people, 3 or 4 years, a lot of people will have already saved that amount to get their 5% deposit. So I suspect this scheme will be very, very popular and obviously will provide an additional boost to the property market. So those three things, lower rates, ongoing shortage, low deposit scheme, will all provide a boost. Are they good? I think ultimately you can question that given affordability and so on. Some people would regard this as unfair, but that is the reality of the market we're in, and we have to focus on the reality of it. Now, the solution to the problem in terms of affordability is more supply. But as I mentioned, that's going to take a long time to come through. If we move on to the next slide, which looks at different cities around the country. Sydney is perhaps, Sydney houses perhaps the least affordable. Sydney units aren't that expensive. If I look at some valuation measures I put together, which looks at house prices relative to rent ratios and so on, Sydney units aren't too bad, but the obviously housing is quite expensive there. So if you're sort of thinking about it, we've got this poor affordability issue. Housing is pretty much overvalued right around Australia across the board. Units not so much, and therefore I suspect that unit prices may benefit from the poor affordability situation we have. And interestingly, the cheaper cities, still Perth, interesting, and I think that's because you're coming from this low base after many years of poor returns in Perth or poor price gains in Perth, and also Melbourne. And Melbourne has obviously been affected by a bunch of things. I think Melbourne's done better to supply more homes. But on top of that, and this is a big one, and that's what I mean by in the brackets up there, is Melbourne good value for a reason. And the reason may be that the state government has pressured investors a lot more than in other states, and that's caused property investors to go to other states. Now, in the short term, there may be an argument that means less investors, so less demand, takes pressure off prices in Melbourne, and that perhaps explains the weakness. Longer term, I do see it as a potential problem, though, in Victoria, because it could mean a bigger shortage of property if you don't have the same investor base compared to the other cities. So, but short term, I'd have to say if I was looking for value, I'd probably go for units, and I'd probably say that Melbourne and Perth are the cheapest, although Melbourne probably requires some sort of change in government to make that city more attractive again for investors. So if we move on to the next slide, that sort of summarises my view on property. I think we've got more upside ahead of us. I think this cycle has further to go. Some people have mentioned to me the 18-year cycle in property, which I think referred to earlier. I don't think it operates like clockwork as simply as that. But if you go on that 18-year cycle, then the next peak is probably 2026 or 2027, which is probably going to coincide with the time when the Reserve Bank starts raising interest rates again, although I think that's probably not till 2027, a fair way off yet. We may see macro-prudential controls. Someone asked me about regulatory changes or policy changes. Macro-prudential controls could kick in at some point to slow down the growth of lending to investors, which is now starting to perk up again. There's also a risk out there at some point that the government, having backed down to some degree on the $3 million super tax, might look for other sources of revenue, and the capital gains tax discount and negative gearing could be looked at. Although I don't think Albo would be silly enough to do anything near what was proposed back in 2019. I think it will be very contained relative to what you saw back then. But that's a possibility, and it could act as a dampener. But I think it's a little way off before we get to that. But it could coincide with the next peak, maybe in 2027 potentially for property prices. But I think you've always got to remember here, you've got to put things in perspective. As a long-term investor, I love these charts. It shows the magic of compounding. Cash and bonds provide good returns over the last 100 years, but nothing like you can get from property and shares. And therefore, the key is, yes, we do get these bouts of volatility in shares particularly, and also to a less degree in property. You've got to try and look through that. And it basically shows the value of $100 invested, where you try to reinvest your income along the way, rents or dividends, a bit hard for property, but assuming you can do that, so it's a total return index for all those asset classes, you are better off in a growth asset. So I might just leave it there. Next two charts summarise all of that. I think it's always pretty important to turn down the noise around investment markets. If we go to the next slide, that certainly includes the property market, and put things in perspective. And of course, in this chart here, it looks like people are doing really risky things, whereas in reality, you can see it in the next slide, it's not that risky. If we go to the next chart, which shows what they're actually doing, hanging off a rock and taking a photo of it. So I think it's the same. When you go through these big cyclical swings, whether it's the property market or the share market, try and put it in perspective, realise that these things often happen. They're not that unusual. So I will leave it there, and I will hand it back to Travis. Thank you.
Amazing, Shane. Thank you so much for the overview of the current Australian economic climate, and as always, giving a great insight with regards to where we've been, where we are, and where potentially we might end up in Australia. What I'd like to do now is talk to you a little bit about our strategic position and why we do what we do, and why you can bank on AMP. So one of the couple of things that I'd like to share with you today is our where we've invested. AMP is heavily invested in our broker channel. Over 90% of the home loans that we originate are through the actual third-party channel through brokers. So our main focus within our business is to continue to focus on you, look at the tools and the resources and the platforms that we develop and products and pricing specifically to suit you and your customers and making sure that we continue to add value to you and your business. Our policy and product changes are done in consultation with brokers at all times. We've run multiple forums throughout this year asking brokers for their feedback in regards to products, pricing, what their customers are asking for, and how we can add value to continue on our strategy of helping customers build property wealth through property. So some of the proof points of our value proposition for a broker is we continue to support brokers and grow small businesses, and how we can do that is through our business finance loan. For some of you may not be aware of that particular product that's available in Marketplace. We actually offer the opportunity for you as a broker or even the financial planners to free up equity from your trail book that you actually have built up over a large period of time and actually want to maybe free up some of that equity to be able to put that back into your business, help you grow, help you actually build and continue to develop your business moving forward. And then I might also be that you may have another trail book that you're interested in looking at to expand your business and actually help you grow your overall net foot position and footprint in the actual marketplace as a mortgage broker. So if you are interested in our business finance loan, feel free to jump on our website and talk to our team in the business finance team. The other opportunity is we've been looking at how do we continue to look at products and policies that continue to provide benefit to you in the industry. And you probably are aware that earlier this year we launched our 10-year interest-only product. That product was specifically designed around, again, looking at the pre-retiree, retiree type customer, helping them free up and provide flexibility to their ongoing repayment and lifestyle. That allows them to look at, without having the need to review that at a 5-year period like most of our counterparts in the industry do at the moment. So a 10-year program has certainly been well received and certainly got the tongues wagging in the industry. A lot of chat about it, which was fantastic. So if you're interested in finding out more about our 10-year interest-only product, please feel free to reach out to your AMP BDM, who'll be more than happy to assist. The support that you have at AMP is also continues to expand and our expertise continues to develop. Our BDMs on the road, we have road-based BDMs in each of the states that to support you in your business. But we also have our desk-bound BDM and also our BES team. The BES team are there to support our BDMs and can making sure that whilst our BDMs are meeting with you as our brokers or at PD days and conferences, that our BES team continue to provide you timely responses to your inquiries regarding your loans and your applications and scenarios that you've got. So our BES team are an imperative part of our business and we'll continue to develop and support them in their roles. For those that have used the new Loan App platform, there's a live chat function included in that particular program. So we've actually done that to ensure that we continue to actually assist you in your business and making sure that you have live people to speak to. We're not here to remove the human element of the actual experience you have as a broker, and so therefore you have live chat functionality. Also with our credit assessors are there to discuss the right solutions for your customers and making sure that we help you package up that loan specifically in the best possible light for your customer and getting them the best deal in the marketplace. Last but not least, the seamless experience that we've built for you. We've spoken about the digital platform end-to-end that we've actually done for you and what we've been able to create for you throughout this year. That's been a really, really well received. We've been overwhelmed, as Melissa said, regarding the platform and the number of applications that have gone through. So again, we thank you from the bottom of our hearts in regards to getting involved and actually trusting us to actually support your customers. And whilst the SLAs aren't where they've been designed to be, we are working very hard in the background to bring them back under control, and we'll communicate with you over the next couple of weeks and provide you that update when they've been reduced. Last but not least is our retention process and what we do to support your customers in the event that they're unable to get in contact with you or in the event that they just want to come through to us directly. If they come to us and they're looking for retention purposes, we'll actually assist that customer by referring them back to yourself or actually helping them with a top-up, but your trailing commission continues to be provided through to you. So that's always an ongoing support through AMP, that your trail commission is safe with us. Moving on to part of our strategic position this year and what we've been able to achieve. I've already touched on the 10-year interest-only product, as we've mentioned. We've also got the proactive offset accounts and the management associated to that, which is now set up actually through LoanApp at the unconditional stage. So it's continued to evolve, even though we've actually looked at that in April. It's continued to evolve as LoanApp has actually been rolled out. And we touched on the 10-year interest-only product, as I mentioned to you. We had new serviceability calculators ongoing to continue to provide our policies and benefits that are associated to that. The other great opportunity, obviously, was on the 30th of July, the rollout of the new platform. And that, as I said, I think we've made a lot of noise and a lot of hype about that in the industry, and it's certainly been well received. And again, we thank you as the broking partners to do that. Some of the things that also assisted us with some of that volume was the $2,000 cashback that was actually done with the launch of the platform for eligible refinances. That cashback was certainly, again, very well received by brokers. We've had record numbers, more than the second highest in history for AMP Bank. So again, we thank you for your ongoing cooperation, support and patience throughout that journey. And the last things in October that we've looked at is continued improvements to our servicing calculators, rents expenses, negative gearing, and also the removal of some of the actual details associated to the Helia restricted postcodes, etc., and LVR locations that are available to you on our website. So, guys, that's a lot that's been going on. We've had a huge year so far, and we continue to look and develop, continue to talk to brokers throughout, whether it be out and about and coming to see you out in your offices, whether it's at PD Days, conferences, or getting you into forums to come and talk to us. We're always here to continue to look at how do we assist your business, support you and your customer. What I'm going to do now is pause and actually introduce Louise Chisholm, who's the head of lending and everyday banking product, to come up. We've got some really exciting news to share with everybody today. Lou, I'm absolutely pumped and excited with what you're about to share with the team today. So I'll hand over to you and not steal any of your thunder.
Great. Thank you, Travis. So, as Travis mentioned, we had some great news to announce. Within Q1 of next year, we are going to get back into the market of Super Edge. So SMSF lending. So our product, the Super Edge product that we previously had in the market for SMSF, is going to be relaunched. There might be some variations on the actual product specs, but that's going to be relaunched in Q1. The reason why we're doing it, why we getting back into the SMSF market, it's been a few years. Banks did get out of the market a few years ago. There was a lot of ASIC reporting at the time, mainly related to concerns around the quality of financial advice for customers that were using SMSF products. There was also concerns about tax treatment and the size of funds and whether they're right for customers. We feel like there's been a lot of change in regulation and in the governance and oversight over SMSF, and so now we feel like it's appropriate time to get back into the market. It also fits nicely along with our group strategy in terms of getting into the pre-retiree and retiree segment and looking after making sure that people retire with confidence. And so we feel like it's a really good product fit and really fits our customer value proposition.
So I'm just going to jump in, Lou, and just have a chat to you about it, because this is really exciting news, and I'm absolutely pumped with this particular news. So talk me through it. So we're bringing out self-managed super funds, going to come back into the marketplace. What sort of timings are we looking at for that? Have we got some sort of time frame for that?
Thank you, Q1 2026.
Awesome.
We're working on the build at the moment, all the product specs and finalising everything. So we're going to say Q1 2026.
But hang on, there's more, because I know you're going to share with our great broker partners out there today in regards to some of the features that are going to be and the policy that's going to be aligned. We don't have the policy ready to share out to market yet. That's true, but I'll get you to share maybe the top 2 or 3 things that will be associated to that new product.
Yeah, so we will definitely have an offset account linked to the product, so
awesome.
Definitely looking for that. We feel that's a really important feature for our customers and really assist them. Also, we'll go up to 80% LVR at this stage and looking at interest only as well.
Okay.
So they're some of the high-level product specs that we will have.
So more of that credit policy and details associated to that will come in the coming months out to our mortgage broking partners, and we'll continue. But what amazing news, we're going to be the only bank in Australia assisting the third-party channel with the self-managed super fund product. So that's really exciting.
That's exciting. I feel like I should call you Big Kev.
I'm excited. All right. Thank you, Lou. That's fantastic. Thank you for sharing that great news. What I'll do is invite Melissa Christie back onto the stage, and we'll go into a Q&A panel discussion. So, actually, we'll go back one. Just going to bring up the Q&As, the questions that we've got from the team. So I might start with Lou, with yourself, if you don't mind. Will you ever bring the previous combo offer where you priced investment the same as owner-occupied?
It was a really good offer. At the moment, we always review our pricing, obviously, and see what makes sense, giving funding costs and all the rest of it. But never say never, but just not at the moment.
That's fair enough. Yeah. We'll continue, obviously, have broker forums and other pricing requirements and things to ensure that we're meeting the market expectations as well.
Yeah.
Yep. Are you getting a lot of business through your new self-employed policy with the 1 year tax return that was introduced in July last year?
Yes, we are. It's been very successful, and I know others followed, but we were kind of leading within that policy changes, and it was really successful and continues to be really successful. We have a high proportion of our applications are from self-employed borrowers.
We've had a question, and we've already answered it, but I want to reiterate this again. What other products we're bringing out in 2026? The self-managed super fund product is huge.
Yeah, that's huge. We're also looking at other ones too. We've been talking to a lot of brokers and getting some feedback from them about what product innovation we can do that fits within that pre-retiree space and looks after their needs. So we've got a good few ideas on the backlog of product development, but main focus at the moment is SMSF.
Self-managed super funds, awesome. But we'll then share that throughout the year of 2026 with what else is coming. So watch this space. Yep, amazing. Melissa, one for you. With the new platform, does the system scan the company tax return, note of assessment, and ITR as yet?
No, it doesn't as yet. We do the individual tax return and notices assessment, and we have on our backlog to do in 2026 the company tax return and notice of assessment. So watch this space. We will get to it in 2026.
Thank you, Lou. Thank you, Melissa. As you'll appreciate, we have a limited number of questions this afternoon due to the technical difficulty. I'd like to thank the brokers that took the time out of their business to come and join us this afternoon. We will be sharing the link with you and get that out to you as quickly as possible post this event. And any other questions that were raised through different forums throughout the actual day as well, we'll be able to provide that in Q&As out probably through our AMP newsletter later in the week. So once again, thank you so much for attending the Q3 webinar. We're again, apologies for the technical difficulties. We look forward to providing more information to you soon, and thank you for your ongoing support. Have a great afternoon.